Hi, my name is Sasha Stoikov, and I'm head of research at Cornell Financial Engineering, Manhattan. So every year I put together about 10 financial data science projects and I manage them. And in this video, I will explain how projects work, give you some examples of projects we've had last year, and finally let a couple students speak for themselves about the projects they worked on. I hope that if you're a prospective student or a project sponsor, you'll be inspired to join us in future projects at Cornell. So, projects typically have three main stakeholders: the company sponsor, so that's typically a quant at a financial company, a team of 4 to 6 students, those are our Masters of Financial Engineering students, and a faculty advisor who could be a faculty like me or other professors at Cornell who are specialized in the project being sponsored. What students learn in these projects is to apply the theoretical skills they learned in the classroom, and they apply them in the real world, and so they get to work on research projects in a group, and finally they work on very cutting edge topics, which allows them to develop interesting ideas that allow them to converse well during interviews. What companies learn is that they're able to explore promising new areas of research and often get to observe potential new talents to hire. This is also an opportunity to collaborate with academics at Cornell, and really what this is all about is about sort of closing the gap between practice and theory. All right, so last year we had 9 or 10 sponsors, and all very, very impressive quants in the financial services industry. And what I do when I approach them is I ask them to think of a challenging problem they face in terms of a simple one sentence. How can we and dot dot dot, and sort of I ask them to complete that sentence, and I also ask them to talk about a data set or provide a data set that they think will be helpful in answering that question. So one example is last year we had an exchange called Memex who asked the students, how can we develop a competitive midpoint order? And as you know, exchanges compete with each other for clients, and many clients want to trade at the midpoint. In other words, they want to maximize their fill rate and minimize price impact. And midpoint orders are a way to achieve that. And Memex was interested in hearing what kind of recommendations the students had for implementing a midpoint order. Secondly, we had Alliance Bernstein who asked, how can we apply large language models to news in order to predict stock price performance? So, as you know, last year has had a big boom in the area of large language models, and the idea of this project was to concretely design processes that would allow an investor to increase or find a new source of alpha. Then we had Hummingbot, which is a crypto algorithms company that helps people design their own market-making algorithms. And they asked, how can we train market-making algorithms for crypto assets? And some of the algorithms that the Hummingbot platform already has work well, but in order to really optimize them, the right parameters need to be fitted through past data, and this was one of the challenges that the students faced. Then we had TP at Goldman Sachs, who asked, how can we predict mutual fund flows? How can we use mutual fund flows to predict investment products that should be suggested to our clients going forward? And this involved building a machine learning model that in fact took many features of mutual fund flows in order to recommend new products to clients. Then we had Deutsche Bank with a very interesting sort of cutting edge project, which involved extracting investment insights from financial podcasts using AI. So this project involved a lot of scraping of podcasts. It also involved voice to text translation, as well as summarizing, sentiment analysis, and prompt engineering. So many of these NLP techniques that are becoming very popular. Then we had Marcos Lopez de Prado, who's also a faculty at Cornell Financial Engineering, Manhattan, and he sponsored a project through his company, the company he works at, Abu Dhabi Investment Authority. In fact, a sovereign fund that invests very large amounts of capital. And he challenged the students with a classic problem in asset allocation, which is how can we disentangle correlation from causality effects in factor investing. And finally, we had a Crescendo Royalty, an investor in music royalty assets, who asked the students, how can we analyze streaming data in order to value music royalty assets? And indeed, looking at patterns of streaming data can be used in order to devise discounted cash flow models, which in turn allow investors like Crescendo Royalties to know what songs and what the right prices are in order to invest in these songs. In fact, I will let you see the video.
All right, so we'll be summarizing our Capstone project sponsored by Crescendo Music Royalty Fund. So the use of music streaming platforms has been rising a lot during the years. So therefore, music royalty has been a very popular asset class in the alternative investments. So since our sponsor is concentrated in such asset class, our project serves to create a more robust and quantitative model for predicting future audio streams across a variety of songs, and in order to estimate their fair price. And the output is based on generating growth rates, which is basically percent change of songs during a period of time. And this is based on different characteristics of a song. So this is what we accomplished through this project. So first, we created an automated process that reads in historical audio stream data, and we created 3 versions of the database: weekly, monthly, and annual data. Then we identified 4 song characteristics that we think that have predictive importance, which are core genre, song and artist popularity deciles, and the last one is vintage. And then we created 2 models to predict audio streams. The first one is based on Monte Carlo simulation, and the second one is a decay rate table. And then we tested these 2 models using 22 diverse range of songs. And then finally, we created 9 decay rate tables to help music investors with their evaluation process.
Okay, so let's take a look at some of the results. So as Eugene mentioned, we manually backtested 22 songs. This is the distribution. We did 4 dance, 4 pop, 10 rock, and 4 R&B. This is representative of the 4 most popular genres that people tend to stream on services like Spotify and Apple Music. So we're just going to take a look at some examples to see how our models kind of work. So the first example, this is using the decay rate method. And basically what this method does, as Eugene described, is it looks at how songs of like similar genre and popularity have performed in the past at the same point in time. This is just one example. This is 1950, which is a very popular pop song released in 2017. So you can see in this case, 0.25 is our pessimistic estimate, 0.75 is the optimistic estimate, and 0.5 is like the normal or base case. We can see for this song, the model performed pretty well in tracking the streams in 2022 and 2023. And the bounds 0.25 and 0.75 were also pretty strong. This is just one example. There are some other examples where it didn't work as well, and we'll talk more about that later. This is the other model. This is the simulation model. So what this model does is instead of looking at the characteristics of the songs, it just looks at the past rates of decay of the songs, of like a single song. So for 1950, it actually worked. This simulation model also worked pretty well. The reason why both models work so well for this song is because, first of all, the trend of the song continued over time. And second of all, the song behaved just like similar really popular pop songs in the past have behaved. So here's just a summary of the general results from our two methods. So first of all, the decay rate method was pretty conservative. There were only two estimates where the future streams were lower than the normal estimate out of the 22 songs we tested. It's also interesting that neither model generally performed better or worse for certain genres, vintages, or popularities. What sort of happens is it just depends on the inherent characteristics of the individual song, where the decay rate table method tends to underestimate streams for songs that either stay flat for long periods of time or songs that just have like random spikes because they go viral on TikTok, for example. Whereas the simulation method tends to overestimate, since songs tend not to like have the same trend that they've had over the past 12 months, which is what the simulation model used. But it is better at capturing inherent patterns in a specific song that are very different from what similar songs have done in the past.
Now, a final word on the logistics of the project. So, in April, the companies or the sponsor pitches the project to students. So that means they give a 5 or 10 minute video presentation, sort of outlining the scope and the objective of the project, as well as the data. In May, the students, after giving us feedback on their preferences, are matched to projects, and the projects actually start in September until December. And typically during the project, the advisor will meet the students weekly, but the project sponsor may meet the students and the group maybe once or twice a month. Finally, in December, the students deliver their final presentation and the final report to the company. Now, I hope this will inspire students and future sponsors to sponsor projects and to participate in them. If you'd like any more information, please reach out to me on LinkedIn or email me at sfs33@cornell.edu. Thank you very much. Have a good day.